Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Basically, there's a lot of different markets where you can trade the underlying security or underlying, and this would be a single currency, but you might trade, say gold as opposed to, say, trading other things that represent gold. And some people just prefer them as opposed to another. Also, there's, I guess, as far as your account limits, things like the amount of margin that you can use will change based upon the type of security you're trading. This can affect your risk levels as well. Some securities are going to fluctuate a lot more and have a lot of those tails than you might see in another security that's of the same type of thing. So whether it's gold or whether it's currencies or whatnot, some of them are just cleaner than others. That's a good question, Kevin, regarding do I trade purely technical or do I take anything else into account? I do trade purely technical. I don't focus upon fundamentals at all. I do pay attention to what is coming out as far as economic data, and you especially want to do this when you're trading Forex because a lot of these are going to move the market, and you don't want to be stuck holding a position many times going into these economic data announcements. But I do find that the representation of the data on the chart is a much better way to focus upon where the prices are going to go and how to react to it than focusing upon trying to analyze the fundamentals. Michael does make a point. When you're trading Forex, you're basically paying the spread, and for short-term trading, it might be more expensive. That is true, but also if you're looking at account sizes, it does offer the possibility for some traders to participate in the market that otherwise would not be able to do so. There are Forex, mini Forex as well, so you can trade mini futures in the Forex as opposed to just trading the spot market. So if you're interested in that as well, that's another way to go. Or you can do the ETFs, meaning that instead of, say, trading the U.S. dollar FXY or U.S. dollar JPY, you would trade the FXY, which would be the ETF for the U.S. dollar yen pair. Options also have, options are one way that you can also reduce costs because you do have set specific prices that you know going into it, basically what your cost is going to be. But I really do think that with Forex, the spreads are becoming so much more narrow, especially over the last year or two than they were to begin with. And it's really becoming a more competitive environment than it used to be, where it is more applicable to the individual speculator than it was, say, 5 or 6 years ago. Actually, when people first started getting interested in trading Forex, I was really against it because there were so many places out there, the spreads were so big that the opportunity cost alone of getting into a pair, you were paying so much more than you would any other type of security that it was really ridiculous, and the prices were so different depending upon who you were trading with that it was really a much more risky market than it's become. It's become basically regulated itself over the last couple of years, so it has become a better market for individual traders, I think. I mean, certainly about 8 years or 7 years ago, I was completely against most traders, particularly newer traders, coming into trading Forex because it really was a more dangerous environment for them. it still is something where you do want to make sure that you're not coming into it completely unprepared, because when you're looking at trading Forex, whether you're trading options, you're trading the spot market, you're trading the minis, whatever, you do have higher risk levels involved because you're trading contracts as opposed to share size. So share size, you can risk, say, $10 on a trade very easily just by trading a couple of shares. But trading contracts, you're going to be, even with one contract, you're getting into a situation where you are going to be risking more than that on every particular trade.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.